Welcome to Bite Size Business, the channel where we use financial metrics and ratios to gauge the financial health of companies. In today's video, we will conclude the shipping series and take a bite into DHL. DHL's history begins in the 1960s at UC Berkeley, when a student began doing a courier service taking the latest and earliest flights between Oakland and Los Angeles international airports to deliver packages for an insurance company. After graduating, him and two friends decided to expand the idea and combined initials to form DHL. The company's relation to Germany begins in 1998 when Deutsche Post began buying shares and in 2001 had gained a controlling interest in the company. By the end of 2002, Deutsche Post would fully acquire DHL. Under Deutsche Post, DHL would acquire a large amount of small courier services. In 2009, DHL would effectively leave the U.S. market, canceling its domestic pickup and delivery services, but in 2010, DHL would sell off its UK assets, and now primarily focuses on mainland Europe, or European Union transports. In 2018, DHL re-entered the U.S. market, and through COVID saw some growth, but is still far behind UPS and FedEx in U.S. market share. UPS holds 37% of the market, FedEx 33%, and DHL 20%. Jumping into the starters, we can see that in the last 12 months, or as of their most recent quarterly report, the company has done $82.8 billion in revenue within the last 12 months. They've done $10.5 billion in EBITDA and $3.2 billion of net income. Jumping over to the balance sheet and looking at the most recent quarterly report, we can see that the company has around $66.9 billion of assets. They have $44.2 billion in liabilities. About half of this is total debt. As of their most recent report, it shows $22.3 billion of debt. And this leaves us with $22.6 billion in shareholder equity. Jumping over to the cash flow statement, as of their most recent reports, we see that they did $8.1 billion in operating cash flow, and they did $5.3 billion in free cash flow, as well as a continued streak of around $1 billion a year in stock buybacks. The company doesn't have a dividend within the last 12 months because they pay a yearly dividend, and so it's not really reflected, as most companies in the U.S. market pay a quarterly dividend. But they've been paying around $2 billion in dividends, and so that's something that we'll get into later on the dessert section. Jumping into the main course, we can review some of the information off of those financial reports that we saw in Yahoo Finance. Today's company was Deutsche Post, who owns DHL. They trade under the ticker symbol DHLGY. This is their OTC markets listing. A lot of European companies that I've seen that have stock that's available for trade in the United States ends in that GY. I'm not too sure why that's the case, but it's something I've noticed, so that's a little interesting tidbit there. They're in the shipping or logistics industry, just like FedEx and UPS. Their revenue comes in slightly behind the other two at $82 billion, or almost 83. It's up from the year before, but down pretty sharply from their 2022 numbers, which is a pretty consistent theme. We can see no company had revenue growth from 2022 to 2024, and I believe DHL, from looking at this, is the only company that actually had growth between 23 and 24, which is another interesting thing to see. Maybe the European markets are recovering a little faster than the U.S. markets. We look at the EBITDA, we can see they came in at $10.5 billion, pretty steady from their 2023 numbers, but down about $2.2 billion from their 2022 numbers. Again, pretty common theme of EBITDA dropping. The only company that's seen EBITDA growth in that time was FedEx. But even their stuff dropped from 2023 to 2024. Taking a look at net income, we can see $3.2 billion, again slightly behind FedEx and UPS, and that has dropped off significantly since that 2022 number, and even a fair bit, dropping by about 10% from that 2023 number as well. Taking a look at total debt, they're sitting in a better position. Granted, they are a little smaller on revenue and profit, but they're sitting with much less debt than FedEx and slightly less debt than UPS. Looking, assets are most similar to UPS's numbers, and so that debt is probably a little bit more comparable, and they have slightly less liabilities than UPS. Shareholder equity comes in right at the middle, being slightly above what UPS has, but well below what FedEx has, coming in around 5 billion below. We can look at free cash flow, where they actually tend to have the strongest numbers, coming at 5.3 billion within the last 12 months. That's down from 5.8 billion the year before, and from 2022 it's down from 7 billion. Again, a pretty common theme seeing that drop off, but they had a less significant drop off than UPS, which is something that's interesting to see as well. Looking at buybacks, they are kind of splitting the difference again. In recent quarters, UPS has done slightly less in buybacks, but that's again, markets are changing, and so that might ramp up in the coming time, especially with their share price being as low as it is now for UPS. Just I believe about 12 months ago, that stock was trading closer to the $180 range, and now it's trading about $120. And so the company might be willing to take on a little debt to buy back stock while it's cheap because they can get a better deal. But even for DHL, the $1 billion a year that they've been doing is pretty consistent. So this is the dividend I was talking about earlier and how it's a little different. So they pay a yearly dividend and not a quarterly dividend, and so the growth looks a little different. They try to target a 60% payout ratio off of their net income, and so that's kind of reflected in their numbers. They don't like to drop their dividend, but if they can't afford to raise it, they won't raise it. So based on projections on their net income and their payout ratio, which is what I have listed right here, I think it'll probably be about the same, that $2.2 billion mark, and so that's what I have factored into some other things. Taking a look at the ratios, we can see that DHL has some decent numbers. They have a low debt to equity coming in at under 1, just slightly, but still under 1. A debt to EBITDA pretty similar to UPS, but still the lowest of the batch. The EBITDA margin is higher, coming in tied at around 13% with UPS, and a lower net profit margin at 4%. Again, this is a low margin industry, so not too much of a surprise there. The buybacks as percentages of free cash flow aren't as important, as it's just a metric to see how much more they could do. And so that 20% just means that between their operating cash flow and free cash flow, that payout they have between those two numbers is 20%. So they could actually about 5x their buybacks if they wanted to be cash flow even, which would be zero free cash flow. Again, we can look at the compound annual growth rates. It was negative for just about everything. Negative 6% year over year for revenue and negative 9% for that EBITDA, and coming at negative 13% for that free cash flow. Again, that's just an industry trend, and that'll probably change within the coming years. Taking a look at the final section in this, we have the comparison. So Deutsche Post, or DHL, has a neutral debt to equity. They have a neutral debt to EBITDA, a neutral EBITDA margin, and a low net profit margin. The debt to EBITDA is really the most important number or most important ratio on here. And so that being neutral is a good sign, especially with the drop that we have seen in earnings from this industry. And so I'm going to go ahead and give them a green light. Being that this is the last episode in this series, I'm going to kind of review some of these. And so FedEx is actually the one I'm most worried about, because they actually didn't experience that much of a drop off on their earnings in the last couple years. So the fact that they are still sitting at that high debt to EBITDA can be a little worrisome. And so it makes me respect the financial people at UPS and DHL a little better, because even with the drops, they've managed to keep their companies in pretty good financial situations. Jumping over to the dessert section, we can see that total buybacks for DHL were a lot less than the other companies, but they've been keeping it steady at around $1 billion a year. They're about half of both FedEx and UPS in buybacks, and so that's a little lackluster, but still fine. They have total dividends of around $6.6 billion. That is factoring in what I assume their dividend for this year, for the 2024 yearly dividend, is going to come out at. And so that could be slightly different. That's just my projection. The total distribution is very similar to that of FedEx. FedEx, we can see, was a lot more buyback heavy. and less dividend heavy, and Deutsche Post or DHL was kind of the opposite, more dividend heavy, a little less buyback heavy. And so that kind of balanced it out, putting them within $1 billion of FedEx's numbers. But really, no one can touch UPS when it comes to their distribution. Taking a look at this is kind of like a metric that I made, which is their total distribution back to shareholders based off of their EBITDA from the last 3 years. I think this is an important number because EBITDA, again being earnings before interest, taxes, depreciation, amortization, is a pretty good gauge of a company's profitability and what they can bring in. And so a higher payout ratio based on EBITDA would show um, a pretty good picture of how much the company has faith in itself financially. A higher payout ratio might mean that they're more confident in their standing, and also how willing they are to get money back to shareholders. Um, Another thing is these numbers will likely be higher than they really appear because this 51% is factoring in a huge drop in EBITDA. And the same thing for that 34, which was a little more steady, and that 29, another large drop in EBITDA. And so that percentage might come out a little higher than it truly is, so that's something we do need to remember. Taking a look at the shares outstanding for Deutsche Post, one thing that we can kind of get out of this is, and we can see they got some specs up here, that they have been declining for the last few years, and that's also shown here. It's kind of interesting to see that their shares had tended to grow, and so they would grow and then they just kind of all go away. And so that's something that's kind of interesting. But as we can see, since really 2021, they have been dropping pretty steadily, aside from a little tick up here in that 2024, where they added, it looks like, about 20 million shares. And so that's nothing really to be worried about. They are starting to do about $1 billion a year in buybacks, and so I think their shares outstanding could probably get to that $1 billion or billion share mark, and that would be a pretty good point for the company. I don't believe this is their primary listing, and so everything won't fully be reflected, but it's still kind of an interesting thing to look at. So getting to the check for DHL. So in recent years, DHL has had issues with their air transport business. They had a crash recently in Lithuania last month, just in November, and a crash in 2022, which is, I believe, the one pictured, where they had a plane split in half on the runway, and I think it was Guatemala or Costa Rica. And so that's something that's kind of interesting. You don't necessarily want this to happen because it's not only just a big issue for the company when it comes to safety, but just from financial perspective, um, it will likely cause some more regulation on them, which could increase costs. They probably got to go retrain all their pilots now, just so they're still, keeping good faith with the air traffic controllers for these different countries, especially being that they are primarily a European and then cross-continent transport group between the Americas and Europe. Their plane safety is a huge thing because a lot of their goods are being transported on these planes. And so losing one plane like this is going to cost them a lot to get a new plane either bought, because I don't think that's fixable, but it's also just going to cost them a lot in lost revenue because they won't be able to get packages across. And so that's kind of something that is important to watch. Another thing that I want to mention with their check is that they are primarily European based, and having so much exposure between Europe and America can sound like a good thing, but it really kind of puts them in a bad position because it's very rare for both Europe and the US to be growing at a quick rate, and you need a growing economy to have a really good logistics business. Because when the economy is growing, there's normally, oversupply of people in these companies, so they're all, flooded with employment, and when that happens, there's a lot of, documents, and there's a lot of things that need to get shipped and moved. And so that's kind of where these shipping companies can do the best. And what we're seeing with this, work from home thing and some shifts to a lot more digital stuff is it's kind of falling back. And so if the economy slows and there are less people working at some of these companies, especially in the office buildings, we might see a lot less shipping. And given that they're exposed to two different markets, it's pretty likely that they're going to have a slow half of their business no matter what. Whether the US is a little slow and Europe's picking back up, or Europe's slow and the US is picking back up. And so that's something that we kind of need to watch and just keep in mind. So I hope you enjoyed this video on DHL. If you did, feel free to like and subscribe. If you have any suggestions for how I can make my content better, or any companies or sectors you want me to look into in the future, please leave a comment below. Again, thank you for watching.